Welcome to the webinar. My name is Marty Schenkman. I'm joined by Alan Gassman and uh, Jonathan Blotmacher, and we're going to talk about the big, beautiful bill. We're going to start by Alan providing an overview, and it's just an overview. We're not going to dig in great detail to all the nuances. I mean, one of the things that's very apparent from the big, beautiful bill is that the breadth and scope of it is just incredible. It affects scores and scores and scores of tax provisions. So we're just going to give an overview, and I'm going to assume that most of you, all of you, will have heard of some of the basic changes. We're going to talk very briefly about some of them and how they affect estate and related planning. And then the focus of what we're going to do is talk about estate planning after the big, beautiful bill and make some points on how planning may be different, but most important, why planning should continue and proceed. I've had a number of colleagues make comments to me like, gee golly, it's really easy now to plan for anyone under $30 million because it's simple. There's no tax. That is not the right analysis at all, and we're going to talk about that. So to get us started, Alan, you're going to give us an overview of what is on the slides, and remind me when we're done with this slide, I should stop sharing, and then they'll just see bigger pictures of us. How lucky. But you start, and Jonathan and I will comment as we go.
Okay, I'm going to tell you, first of all, the top 13 money savers for taxpayers. And then we're going to talk about some other significant ones that I think everyone already knows about, but maybe would like to know a little bit more about. And the first one is the tax rates stay low. We're at a 37% highest rate, and that is saving taxpayers $2.7 trillion. I mean, that's really most of what it is just the tax rates. If they would just leave us alone and not make us learn all these other new bills, they could have done most of the job just based on tax rates.
So Jonathan, with a 37% tax rate, which is what we've had for some years now, that still leaves lots of opportunity for tax planning by shifting income to non-grantor trusts or to lower bracket family members, yes?
Well, yes, Marty, it may. Of course, you have to take into account state income taxes. It may also be that you have capital gain or you want to convert things to capital gain because that will still be lower. But yes, the lower rate does matter. But again, I don't know how much it is. And don't forget, you have the net investment income tax that also may add, 3% more, which is non-deductible for regular tax purposes. So when I talk to people, I don't talk about a 37% rate generally. I talk about a 40% rate. Maybe there's not that much difference, but if you're very wealthy and you make a lot of money, as Alan and Marty do, that 3 point whatever it is percent will make a big difference.
Yeah, 3.8%.
But the key take-home point, and this is fundamental to planning, there are still income tax planning opportunities that relate to the estate planning we do. And we'll come to some of that in the next part of our program. Alan?
Secondly, the big surprise to me, $900 billion of tax savings from what will now be a $31,500 standard deduction for married filing jointly and a $15,750 standard deduction for single individuals. And we'll talk about how this impacts or is impacted by the SALT deduction and the charitable deduction in a little while. But that's an increase in the standard deduction. People aren't going to have to do much. It's just going to be good for them.
So with just very quickly, with a high standard deduction, fewer and fewer people will get a benefit from charitable contributions. And I don't think it made this high top 13 list, but there's a $1,000 or $2,000 above the line deduction for contributions. But we as estate planners can help people maximize the deduction value for charitable contributions by shifting passive income, interest and bond income, et cetera, to a non-grantor trust and having the trust pay the charitable contribution deductions, because trusts are not subject to a standard deduction and can deduct subject to 642C charitable contributions. Not detailed now, but we may come back to that later. So again, I'm just trying to point out when Alan tells you the benefits,
Marty,
some of the implications.
Yeah, the standard deduction won't be available or used by most people, especially those who may make significant charitable contributions. But you may want to make sure you get to deduct your charitable contributions. And the way you may be able to do that is to have non-salaried income like dividends, interest, rents, and royalties received by a non-grantor trust. Because if you authorize the trust, assuming it won't disqualify the trust for some tax benefit like the marital deduction, you can authorize the trustee, not direct it, but authorize the trustee to make contributions of its gross income to charity. And it's a lot simpler regime than you do with individuals, where you have to worry about the kind of charity involved. You have to worry about limitations compared to the adjusted gross income. So I have been urging, and Marty and I have written about this, that you want to make sure that your instrument authorizes, doesn't direct, but authorizes the trustee to make contributions of gross income to charity. That way you get the full benefit of the deduction, and because you'll have income in that particular trust, it can be a great benefit. And again, Marty and I have done articles about that. We can send you sample language. It's also contained in interactive legal, and it's really something you should do in every trust you create from here on out. And by the way, just a warning, it does not appear that you can amend by decanting or otherwise a trust in order to authorize the distribution of its gross income to charity. It's really got to be in the trust. One of the requirements is that the person who created the trust actually has to be the one to authorize it. It just can't be that after the fact you say, well, gee, we thought we would authorize this and now we've done it. So keep that in mind, and you'll be able to get better benefits from it. And again, it ought to be in every single trust that you do. You make it a non-grantor trust and you get the benefit of paying gross income for a charitable purpose and get the full benefit of the deduction in effect.
We're going to, two quick comments. We're going to come back to that thought because what Jonathan just explained is actually a very creative planning idea for not just the uber wealthy, but for the average American. And it has to be applied in a different cost-effective way. We're going to talk about that after. Eventually, we'll let Alan get through his list. Second point, what Jonathan just brought up is, to me, and I'm just going to bring it up here because it just, Jonathan has spilled the beans. One of the most important aspects of estate planning after the big beautiful bill for many clients is not going to be avoiding an estate tax now, but rather getting income tax benefits. So just keep that in mind. It changes the dynamic of what we do. It doesn't make us irrelevant. Alan?
Okay, and we've mentioned charitable, so let me tell you what's changed in the charitable world. Every person can donate up to $1,000 and deduct it without regard to the standard deduction. It's equivalent to the $300 exception that we had during COVID. And for a married couple, that's $2,000. Just donate it, deduct it, don't worry about the standard deduction. The other thing that is going to be deductible without worrying about the standard deduction is interest on a car loan of up to $10,000. So people who can barely afford a car are going to be a little bit better off because they'll be able to write off the interest on their car loan for up to $10,000 of debt. That will get them into a drivable car.
U.S. drivable car.
U.S. drivable car.
Got
Now,
to be assembled here.
Right, that's true. In addition, while I'm mentioning charity, there's a little limitation now. 0.5% of your adjusted gross income reduces your charitable deduction if you are itemizing. So if you make $1 million a year, 0.5% is $5,000. So if you donate $100,000 during the year, then you'll get a tax deduction as if you donated 95,000. Now, why they did that?
I was just going to ask you, why did they do that?
Why would they do that? I have no idea. All it's going to do is confuse people.
Well, I think it's, to be abundantly frank, they were trying to limit the effect of the tax law on loss of revenue to the government.
Yeah.
Well, by the way, that's another theme of the big beautiful bill. Little complicated unanticipated, not intuitive nuances like Alan just described permeate the bill. It's almost dangerous to try to guess or remember any of these provisions because phase outs are different, as different income levels for phase out are different, years that they're effective can be different. There's a lot of little nuances like what Alan and Jonathan just commented on to make the numbers. I hate to say work because it's still a huge impact on the deficit, but in order to get to whatever result they thought was palatable to get through Congress, there's lots and lots of nuances like that. It's really incredibly complex. Alan?
So, yeah, so the next thing they did really was for primarily the middle class. And you see there $400 billion of additional money paid out for the child care credit, $2,200 per child. So while they did roll back Medicaid and food stamps equivalent programs, the per child tax credit is going to be a big thing for the middle class. It does phase out for the higher income people, but it's a big thing. Section 199A was made permanent. The Senate wanted to move that 199A deduction up to 23%. I'm sorry, the House wanted to move it to 23%. The Senate kept it at 20%. That's how it passed. They changed the phase out for the higher income taxpayers. If you're in a specified trade or business, or you don't have a lot of wages in the business or a lot of property in the business, your phase out is a little bit more generous now. But otherwise, 199A is permanent, and setting up separate trusts for grandchildren under Section 678 to spread out the income of a business is something that's very worthwhile. You can save $4,000 to $6,000 per child per grandchild by doing that per year.
And then qualify for the 199A for yourself.
Right.
Let me just Alan,
Yeah.
not everybody may remember what a specified service business is. Maybe you could just comment. Who are the lucky losers besides us lawyers?
Accountants, actuaries, architects, doctors, people who actually earn their living working in their profession, and including consultants, which is a pretty broad curtain. So then number five.
What Alan just described to me is another theme of the big, beautiful bill. And it's troubling to me. And that is how so many special treatments of different people or different activities or different incomes are carved out in the big, beautiful bill. So, for example, a real estate developer or a business that relies on capital, not a specified service business, gets the full 20% discount. Lawyers, accountants, doctors, we don't get the 20% discount, as if our income is less favored. And you're going to see that with tips, with Social Security. There's so many different implications that it seems to make not only planning harder, but to be able to predict the impact on the economy has to be daunting, because how can you predict the impact of all these different nuances? And there's a fairness issue, because why are certain types of income or activities or people favored over others to such a degree?
Yeah, good point. Another interesting one on 199A is that if you have $1,000 of qualified income, then you get a $400 deduction. And that phases out when you get up to $2,000. So I guess if you make cakes on the weekend or something, or go to the flea market and make $1,000 a year, you're going to save maybe $60 in taxes. So why would you put that in a statute? I don't know.
But how's an accountant or even a person that goes online to do their own tax return? There's so many little details like that. How are people going to remember them?
Yeah. So then the next one, and this is
one of the things that will happen, not for planning, is that the computer programs will automatically tee this up. So when you're doing your return, as you get to certain levels, they'll tell you, what's the effect of adding more income or adding more deductions. But it's important to consider it, especially for people who aren't as high income as you two are.
All right. So number 5, coming in at only 200 billion, is increasing the estate and gift tax exemption to 15 million per person, 30 million per couple, And it appears that there were no other significant changes to the estate and gift tax law. So I'm thankful that I don't have to learn a lot of new things in the estate and gift tax law. It's just now a matter of looking at your estate planning in a different way. And that's why I'm really glad we're here together to talk about all the different things that means in a few minutes.
Yeah, one of the things is that you don't have to worry about the recapture of the benefit. Remember, there was a proposal by the Treasury that once you got above a certain level, and you wanted to still get the benefit of prior uses of your estate or gift tax exemption, you were limited in that. This eliminates that. You don't have to worry about it. And of course, could change the law in the future, but it means if you want to make a gift now and use your exemption, you won't have to worry about it being recaptured at a later time.
Jonathan, are you saying that the webinar that we did on clawback is no longer useful?
I'm afraid that's right, Marty, but
Our
maybe,
residuals are going to drop.
yeah, but keep in mind, it may come back.
It may, certainly. Okay, number 6 at 142 billion is the increase in the state and local tax deduction to 40,000. It's only temporary to 2029, but that's going to save a lot of income tax dollars for high.
But it also is subject to phase out. So those who have big income and live in a high tax state like Marty does, it may not do him that much good.
I think for a lot of the clients of the advisors on this program, they're going to get phased out and get modest, if any, benefit from it. So it's not going to necessarily help at all. Let me just point out, even though it seems obvious, but what Alan just said, a lot of these benefits end in 2028. Is it 29 for the SALT or is it 28 like a lot of the other ones, Alan? You remember?
29.
All right, but a lot of them end in 28, but there's all these little differences. So a lot of these things are only temporary. So one of the questions is going to become how much planning can you really do if in 4 years or some short number of years it's gone? And even though it didn't change, there was talk of eliminating the PTET benefits where you could have a flow-through entity pay your tax and circumvent the SALT limitation, but that is still permitted because they did not restrict that.
Yeah. So number 7, they permanent repeal of personal exemptions. Number 8, they made permanent that $750,000 of mortgage debt can be used in computing a interest deduction. So that's nice to have.
That's important, by the way, for parents that help kids buy homes. If you loan the kid the money, if you don't have a mortgage on it, it's not going to qualify as home mortgage interest indebtedness. So just those rules can apply to clients, even wealthy clients helping kids. So don't dismiss that.
That's a good point. Then we have permanent repeal of the piece limitation on itemized deductions. We've got permanent increase of the alternative minimum tax exemption and the phase out thresholds. We've got permanent restoration of expensing of domestic research and
Yes.
development.
Not foreign. Foreign is 15-year amortization.
Right. Number 12, we're back to a 100% tax deduction when you buy a big piece of equipment, you put in certain fixtures, or you buy an airplane or a big boat for charter and you satisfy the passive loss rules, write that $10 million boat off this year, and then convert it to personal use next year and pay rent to use it. So we're going to see a lot more of that stuff happening.
Alan,
Yes.
does that mean you can buy a new puppet?
Yes, I could write off my puppets. It's a great point.
Business deduction. I know you use them on webinars.
That's right.
Although Jonathan and I obviously didn't rate because you're not using it here.
Right. And then the tip income up to $25,000 a year of tip income. It does phase out for the higher earners, and they'll be telling us soon what categories of workers can qualify for the tip income. And then not shown on the screen, but also
Hang on.
Yep.
It says you have to qualify for the tip exclusion. It has to be, I think, regular and customary in the industry. So I think for anyone on this call, attorneys, accountants, wealth advisors that thought they could have clients give them tips instead of billing them, I don't think it'll qualify.
Well,
That's-
how about for a law firm or an accounting firm which pays bonuses? Is that going to qualify?
I'm
Now you're
sure.
talking about the not tips, but the overtime.
Well, either one. I mean, can we pay our associates or paralegals additional amounts at the end of the year? Typically, people pay that. Can you do that now? And so they could get up to 25,000 of this tip income or overtime income and not pay income tax on it?
I think only if they're serving you drinks as a bartender or meals as a waitress.
I
Or
think Jonathan is getting at the overtime, but
okay.
there's a specific requirement. Alan, you may have it. I can't remember it. The overtime has to be paid pursuant to some statute or law on overtime.
That I don't recall, but the overtime is going to be a nice thing.
But I don't know that that's going to work for professional advisors because I think there's a requirement. I didn't look into it, but I'm not sure if a bonus in a professional firm would meet those requirements. I haven't looked into that.
Right. I don't recall. But it's going to be nice for me to be able to explain to my employees that if they work a little bit more, I can pay them a little bit. Won't have to pay tax on it. So maybe I'll get a little bit more overtime from my staff. The only other thing I'll say, and then I think we can go on to our general discussion, is that beginning in 2026, there will be no credits anywhere for electric cars, electric bicycles, electric nuclear plant, all the things. This was a $500 billion swing, saving the Treasury $500 million by not
Billion.
all those things. Yeah, 500 billion. So if you're going to get an electric car or put solar panels on your roof or start a new nuclear power plant, you want to get that in place by the end of 2025. Otherwise, that's all going to be gone.
Alan, you left off one of the big ones where they're clamping down on, solar and environmental things. Bicycle commuting expenses can no longer be excluded.
Right,
So,
$20 a month was the limit on that.
yeah, and I know you bike to work, Alan, so I wanted to bring that up.
The one thing I haven't checked in is what they did to the teachers on the $250 a year to bring paper into the classroom.
They gave a special rule for teachers, educators was, I think, the word used, that they can qualify for unreimbursed business expenses as a miscellaneous itemized deduction. And again, folks, that may not be relevant to you or any of your clients, but it may. But it highlights the incredible complexity of this bill. Alan has picked out the most important, and I found this interesting because I haven't seen it scheduled out like this in terms of numbers. But the breadth of this bill is mind-boggling. It affects scores and scores and scores of tax provisions. And the changes are so nuanced, like Alan pointed out, the 0.5% of I don't know if it's modified adjusted gross income or gross income reduction on charitable contributions, the bicycle expenses. There's so much here that I honestly don't know how any tax advisor can really get their arms around all of it. It's just too massive. You guys ready to segue into what?
Let me just mention one more thing that comes to mind, and that is qualified opportunity zones.
Oh, that's a big one.
You'll be able to roll your capital gains beginning this year into a qualified opportunity zone and have a 5-year deferral on that capital gain income. So instead of paying, so if I have $1 million sale and 300,000 of it was capital gain, I'll be able to put 300,000 into a qualified opportunity zone investment, pay that capital gains tax in 5 years. And then if I keep that opportunity zone investment for 10 years and sell it, then I'll pay 0% on the capital gains tax. So that's out there as well.
And that
Yeah,
could be a big one for
keep
our
in-
clients, even though it's not on the top 13, 14 list of revenue raisers. Jonathan?
Well, one of the things I think that has to be kept in mind, qualified opportunity zones, I think will be a big deal. Bob Keebler has pointed out that maybe what you want to do is have your property, which is going to produce capital gain, but you want to get that opportunity zone exclusion or safe harbor for a number of years, is to put it into a charitable remainder trust, an income-only charitable remainder trust, and then take it out in another year, so you get the benefit of that at a future time and won't lose it. So that's something else to think of. Although keep in mind that whether a qualified opportunity zone is a good deal or not depends primarily on how well it does as an investment. You can make a lot of investments where there are claimed tax benefits, but it's got to be a good investment to begin with.
That
Yeah.
reminds me of when I started in the profession very long ago, and it was common for these tax shelter 2-for-1 write-offs. But in the end of the day, was there anything of value there? Alan or Jonathan, one of you, we should mention QSSBs because that was also enhanced.
I don't recall the exact specific.
I think that, and that's under 1202. You wrote a book with me on that, Alan.
I know.
Come on.
Rewrite it.
We should. But I think it was up to $50 million and they bumped it to 75 million. So the QSSBs and the QOZs are going to be something that a lot of advisors' clients are going to be looking into. And I think it behooves all of us to become more familiar with that. And again, much of the write-ups that I've seen, because stuff is just starting to come out on the Big Beautiful Bill online and in articles and things, they are focusing on the charitable deductions and the tip stuff. That's not going to be the major things affecting our clients. The QOZ and the QSSB will be major. So let's segue to our second segment of the program. So Jonathan, is estate planning only about saving estate tax? What
Well,
do we do
Marty,
after the bill? What should people be thinking about?
Well, Marty, as you know, it's not. In fact, saving estate tax has been secondary for probably a decade as the exemptions have gone way up. Well over 99% of decedents don't have to worry about any federal estate tax at all. There may be, a state where you may have to pay some tax. And the state of Washington, I believe, has now increased its estate tax rate to 30%.
Just recently.
Just recently. So if you
Yeah.
live in the state of Washington, that's something to watch out for. But for most people, reducing estate tax is not all that important. By the way, it should be kept in mind that a lot of states like Pennsylvania and Kentucky don't have an estate tax per se, but they do have an inheritance tax, which is not that modest. So that's got to be considered as well. But you want to keep in mind that estate planning is not just estate tax reduction or elimination. There's so much more that has to be done, making sure that the property is disposed of in an efficient fashion. And one of the most important things that families care about is avoiding creditor claims. And remember, the government is probably the biggest claimant that the family will ever face. So trying to do something like reduce estate tax or reduce inheritance tax does make sense, but that's only a percentage of what you have to worry about. The big thing is worried about basically some creditor, whether it's your creditor or a creditor of a child or a grandchild, including spouses, come in and try to take that money away from your family. Keep in mind that well over half of marriages in the United States end in divorce. And all of a sudden, that person with whom you have shared your most intimate thoughts and emotions with, cared about most, shared everything with, becomes your biggest financial entity. And you really need to think about that. And Alan, let me ask you, what is the number one thing to avoid those kind of claims?
Asset protection trusts or marriage counselors?
Well, I think number one, it's using trusts. Again, you don't have to be any place special as a general rule to get asset protection for a trust that someone else has created for you. So you ought to go to your mom and dad and say, look, I love you. You can leave your property any way you want, but if you're going to leave anything for me, I want it in trust. I want it in trust so that, my spouse can't later take it, or my girlfriend or boyfriend can't take it, or someone who claims I've swindled them can take it. Absolutely critical, the most important thing to do. Now, there's so many ways to structure a trust, but normally making sure you have a discretionary trust, not just for the child, but for the child's family members is there. In fact, Marty, let me ask you a question. Does it ever make sense for me to say, I'm not just going to have my descendants be beneficiaries of the trust, but I want their spouses to also be beneficiaries of the trust? Why would I want my former daughter-in-law or former grandson-in-law to ever be a beneficiary of a trust? I want to benefit my descendants. Why would I want to do that?
I don't know that you want your former being a beneficiary, but while they're married to your child, what it does is, let's say your daughter is in the midst of a lawsuit. She's a surgeon. She got nailed with a couple of lawsuits. You can distribute money, assets to her husband that can use them to pay for benefits for him and your daughter and their family without making distributions to your daughter under a discretionary trust. And in that way, keep the assets protected and continue to benefit your child.
That's exactly right. And again, I know that runs counter to what everybody thinks. I'll do something for my son-in-law. I don't even like him. I don't remember his name. I never want to see him again. But you may want to have that in there on a discretionary basis. And in fact, you can even put in that the distribution to your son-in-law or granddaughter-in-law or whoever it is can only be done with the consent of your descendant. And by the way, I don't think that's a gift at all because it's purely discretionary. But you ought to really consider having that in there. You can put in language why I'm doing that, but it's to protect your descendants. But it's really something you should think about.
Let me just make a comment and flip it to Alan. I spoke to, I've actually had comments made to me from a couple of colleagues, smart people, who kind of said, well, golly, now with the big, beautiful bill and the $15 million permanent inflation adjusted exemption for couples worth under $30 million, I can do simple documents. I don't have to plan. I think that's a dangerous misconception and misinterpretation for two reasons. One, and let's stay with this for a second, is asset protection is something vital for almost every client. And I don't know that it's received enough attention. Alan, maybe make some comments as to practitioners that operate under this misconception that they can just do planning with simple documents because, gee, there's no estate tax. Don't address the tax issue, just the asset protection.
Well, now I have the opportunity to sit with clients who are in that 10 to $25 million range and talk to them about what may be more important than estate tax avoidance because they're off the grid now.
The tax grid.
Off the estate tax grid.
Right.
Of course, I met with a client Thursday who's at 20 million, and I said, do you think that for a married couple, the Democrats may get reelected and put you back in peril? Client said, yes, don't disband any of this, and I'm going to put another 3 million into the SLAT. Because, he remembers that Elizabeth Warren and Biden and the tax plan was a 3.5 million exemption. And just as crazy as this has been under this new administration, it could be crazy the other way soon. So don't forget the estate tax may come back. But now, for example, in Florida, the assets that Marcia and I own jointly as tenants by the entireties can't be taken by a creditor. Well, if we've divided our assets up into separate revocable trusts to capture the credit shelter amount on the first death, and we're not concerned about that, maybe we're better off going back to tenancy by the entireties. And maybe we can also think about what happens if we do that. If one of us dies, should there be some sort of an agreement where the surviving spouse leaves a percentage of assets to the children or sets up an asset protection trust for the benefit of the surviving spouse and children so you don't lose it to a second spouse? And how many more people are going to go with Jonathan's idea of a community property trust now, which wasn't necessarily a great estate tax planning move, but is a great income tax move?
Why don't you explain that, Jonathan or Alan?
Jonathan, it's your invention. You go for it.
Well, I've always been jealous of the fact that 1014B6 says that when someone dies and owns community property, which is basically a form of tenancy by the tenancy in common between spouses, that not just the deceased spouse's interest in that property gets the stepped up basis, but also the surviving spouse's does. So if you live in a state like New York and you and your wife have a $10 million building and you die, your half is going to be includable in your estate, and that half will get the tax-free step-up in basis. But your spouse's half won't. That will continue to have a carryover basis. But if it were community property, because you lived, for example, in California or the state of Washington, or by statute in Wisconsin, you not just get your half stepped up, but your surviving spouse is stepped up as well. And 6 times I went up to Albany to try to convince the legislators that they ought to allow New Yorkers to have an opt-in community property system for New York married couples. And of course, the male legislators knew I was just trying to do something for their spouses and they rejected it. But Alaska eventually did. In 1998, Alaska adopted the Alaska Community Property Act, which says a couple in Alaska can have none or some or all of their property become community property under Alaska law. And in fact, if you're not an Alaska resident, you can still do it by creating an Alaska Community Property Trust. Now, there are some people who feel that can't possibly work, but it appears that if you take a look at a number of cases, including the Angerhofer case, which was decided by the United States Tax Court in 1976, you will see that the courts say yes. If it's community property under local law, even if it's an opt-in system for creating community property, you will get the income tax benefits of community property for federal tax purposes. And I mean, I've saved my clients a tremendous amount of money by doing that, but most people are not even aware of it. Now, there are a number of states, Florida, Kentucky, Tennessee, South Dakota, which have tried to pass similar laws. And Alan, I'm not offending anybody, but I don't think they work. But that's a discussion for another day. But I think everybody will agree that if you create an Alaska Community Property Trust and you put assets in there and declare them to be community property under Alaska law, you will get that double step up in basis when the first spouse dies.
Let me just try to piece together what Alan and Jonathan said. So let's say you have a couple that are worth 15 million bucks. They may have been very concerned until recently, oh my, we better set up non-reciprocal SLATs and get money out of our estate because the exemption is going down, and then we're at the threshold, the cusp of having an estate tax. But what the analysis may now be is, gee, maybe we can set up a community property trust because we're not subject to state tax for now. Put all our assets in the community property trust, and if either of us dies, we get a full basis step up, eliminate all the capital gains, and then the survivor may be able to pursue estate tax planning. Is that the gist of how things have now changed?
Well, Marty, I have long told people that you really, if you can, want to postpone your planning until the first spouse dies and you get a step up in basis. Because let's say you have a very successful couple like you and Patty are, Marty, where you have $50 million, but you did it through a great investment and your investment basis is only a couple of $1 million. Well, you're still facing $48 million of potential capital gains, some of which may actually be ordinary income. But this way, by having it be community property, you can get the best of all possible worlds. You can keep it out of the estate and yet get a stepped up basis without any estate tax, even though you and Patty have $50 million, because your exemptions are going to be even less than that, but you can keep it out because you get 2 exemptions. So you really ought to consider something like that for your clients.
Alan, any more comments on asset protection?
No, but can we start talking about powers of appointment and step ups?
Yeah, hey, let me segue to that. So one of the most important things, and I think we all three agree, is the perception from comments that I've heard from some practitioners that, gee, you know, I can just do simple documents for people under 30 million is a terrible mistake for two reasons. We just spoke about asset protection. Asset protection should be on the top of the list for all practitioners in all fields to be encouraging clients to address. The worst the estate tax is taking under current law, not counting state estate tax, is 40%. But the worst that a creditor can take is at least 100%. So it certainly makes sense to do, and we should not be negating the importance of planning. And I think clients are going to have the same sort of knee-jerk initial reaction. Golly, if the exemption's so far above what I'm doing, I don't have to think about it. No, you do, because the same kind of steps to remove assets from your estate are often similar or even identical to what it does to protect your assets. But the second piece, and Alan mentioned it with his client, let's just talk about that a minute before we go into how we plan now, is that there's no assurance that this stuff is going to continue. So I'm going to do air quotes. A permanent $15 million exemption translated in Washington speak, right, like 1984 speak, is only permanent until the next administration may change it. So we have no idea what's coming down the pike. Alan's client is more astute than a lot of the clients that we all see, where that client said, gee, I have no idea what a future administration will do. Let's keep planning and let's keep moving. I don't think the vast majority of clients have that insight. And that's something that I think the wealth advisors, the accountants, as well as the estate planners need to educate their clients about. The fact that there's no other changes to the estate tax and the exemption is quite high right now, for clients 40, 50, 60 million and under, they should be still aggressively planning. The piece we didn't talk about, and I'll mention it quickly, maybe Alan or Jonathan want to comment. Clients worth 50 million and up, 100 million and up, they need to plan aggressively and continue planning as they should have and probably did before, because they're still subject to massive estate tax. And if the Democrats take control at some future date and we get an Elizabeth Warren type wealth tax, or we get a Bernie Sanders type estate tax where grantor trusts are eliminated, there's deemed realization on trusts, all the things that we were talking about in 2020 and 2021, because it looked like it was going to happen, but just by virtue of cinema and Manchin, it didn't. Those things could all come roaring back in the future. So wealthier clients, 50, 100 million and up, they need to plan aggressively. They should not be even taking a breath. They should continue planning. But I think for different reasons, clients below that level should be planning. So that's the asset protection and the estate tax with the uncertainty. So let's now segue. Alan mentioned powers of appointment. Let's segue there. What do we do different in planning in the current environment? So one, the possibility of what might happen at some future date with the Democrats is so unknown and uncertain. I think we need to infuse incredible flexibility into the planning, perhaps more so than in the past. Second, because these things may not happen for a long time, if ever, we don't know, we can't predict. I think clients need to preserve access to their trust, and we should talk about that. So flexibility, access, and the third piece that may be different, and Jonathan spoke about it already, is considering non-grantor trusts. And for a number of clients, we've done some non-grantor trusts where we've put assets likely to generate a lot of current high income that would be subject to state income tax, et cetera. You may want a non-grantor trust designed to maximize the charitable contribution deduction. So you may only infuse or gift assets to a non-grantor trust up to the level that's generating enough income to make the contributions the client wants. And another concept on grantor trust is when you have all these income thresholds in the big, beautiful bill, even moderate wealth clients worth far less than the numbers we were just talking about may be able to secure meaningful income tax savings by creating an inexpensive, simple non-grantor trust in their home state and shifting investment income out so they can modulate, control the amount of passive income that comes to them so they can qualify for other benefits, whether it's a tip exclusion or other things, all of which have income phase outs. So Alan, with that big picture, why don't you talk about powers of appointment and other things that can be done to infuse more flexibility into trusts.
Right. Well, one thing we've done a number of times, and we'll be combing through our client files to look for this opportunity, is to go to a judge and say, Judge, Grandpa set this trust up 22 years ago to avoid estate tax, and we don't need to avoid estate tax anymore. And we would like to reinstall Grandpa's wisdom and control over the trust by giving Grandpa a power to direct how the trust assets will pass among his descendants in the event of his death. And please give him this power of appointment. Oh, and by the way, now when he dies, we're going to get a step up in income tax basis for this trust. Isn't that a nice thing, Judge? And the judge says, well, that'll save the family tax money. Yep. Okay, where do I sign to get this order done? So, there's unquestionably billions of dollars worth of irrevocable trusts in the United States right now that are no longer needed to avoid estate tax and that are not going to get a new income tax basis on the death of the grantor. So going back and getting that done can be a good idea. Second,
Alan, there is some law, a case called Feuhoff, which was decided by the Second Circuit, where a man had given a policy of insurance on his life to his wife. She died before him and put it in trust for the kids and named him as the trustee. And the IRS argued that because he had created the trust and he wound up having control over the trust when he died, the property was includable in his estate under Section 2038. The United States Tax Court and the Second Circuit said no, it's got to be foreseen. So one of the things is if you had such a trust, I don't think just giving Grandpa a power of appointment will necessarily do it. But one of the things that I do recommend you consider is having an ability to add the grantor in as a trustee. You have a discretionary trust. It's not going to be in the estate, but you give someone the power to appoint the grantor in as a trustee. And because that's foreseen in the document, yes, you can make the grantor a trustee. That should cause estate tax inclusion. And I've written a little bit about that, and it's something to consider when you're drafting a trust.
Okay. Do you think you can find what you wrote so we can share it with the attendees?
Yes, I certainly think I can.
Please do. That's brilliant. The second thing is in our
Oh,
law.
but Alan, the name of that article, it's by Madeline Rivlin, Rivlin. And Madeline was my most brilliant colleague at Milbank at the time. She was just absolutely a brilliant, brilliant lawyer. And she and I wrote this article called Searching for Basis in Estate Planning, Less Tax for Heirs. And we go through that and other strategies to try to save income tax, not just estate tax, because back when we wrote that article, which is now more than 10 years ago, the estate tax was being phased out, but income tax would always remain. So look for that thing. Searching for Basis in Estate Planning by Blattmacher and Rivlin, Less Tax for Heirs. And I think there will be some very, very good ideas in there.
So the clients I met with Thursday who wanted to put another $3 million in the SLAT, the spouse is going to be the beneficiary of the SLAT after the husband's death, and Aunt Polly is also a beneficiary of that trust, and she has a power of appointment that she can direct it to creditors of her estate with permission of their next door neighbor. So on Aunt Polly's death, we're going to have a step up, which is going to benefit that spouse. So that's another good use of irrevocable trusts that is out there for people to use. Another thing we're going to have to do is,
Alan, it's so important what you guys are just talking about, because way too many people focus only on the estate tax planning aspects of estate planning. And the income tax and asset protection benefits can be far more important for many, many, many clients. And that's really important to understand.
Yeah, well, Marty, as you know, it's like 0.2% of decedents have any estate tax. So maybe you
It's
have someone who's
insignificant.
just over the what will be the $15 million exemption, but that's not going to do very much. But everybody has to worry about that step up in basis, and there is no minimum threshold. If you can get the assets in someone's estate, you will get the stepped up basis. And I've even, with my dear friend Mitch Gans, Mitch and I have come up with some ways that you may be able to get assets to have the stepped up basis, even if the assets are not included in the gross estate. That's been somewhat controversial, but if you take a look at the September 2023 issue of the Journal of Taxation, you will see an article by Mitchell and me in how to get the stepped up basis even for assets that are not in the estate, provided it's a grantor trust.
Wow. Fantastic. The other thing is, we've spent years setting up entities so that on death, there will be a valuation discount, which will be a lesser step up. So right now I have hundreds of clients who own half of 1% of the voting member interest in their family LLC or limited partnership, with an irrevocable trust for children or grandchildren owning the other half of 1%, so that on death, we won't have control and we'll have a discount. Well, I've got to go back now and get that voting control back, or give that client a put right or something, so that I get my fair market value basis in those assets. So
What about revising the operating agreement or partnership agreement so that anybody could call for the dissolution of the entity? So now there's no discounts, but now you have to weigh that because you've destroyed the asset protection of the entity. So you may want to think carefully how you unwind your discount, because you don't want to, forgive the commonly used phrase, jump from the frying pan to the fire. If in fact asset protection is important, and we've stressed how that's important, you may want to find a way to gift back an interest or unwind something, or swap out that control interest back to the settlor so they don't have a discount, but you may not want to unravel the entity, because that's pretty easy to do. And then what happens, Alan, if you go through all that and the pendulum swings in Washington and the Bernie Sanders-like tax bill is enacted in the next, 2028 or 2032. Now what do? Go back to it?
That's exactly what we'll do, is go back to it.
I think you need to apprise clients to the fact that, this is one of the problems. We're dealing with laws that are so uncertain and they change all the time, and it all may change again. Makes it very difficult.
It does.
Other thoughts that you guys want to talk about? If not, I want to belabor non-grantor trust just a bit more.
I think you might want to point out to clients that they have big, valuable, permanent life insurance policies that they bought for estate tax purposes that they may not need anymore.
Oh, be careful.
And whether what the best economic use of those policies may be, whether they should become family savings vehicles and not necessarily stuck in irrevocable trusts, whether they should become creditor protection vehicles, or whether the death benefit should be reduced and maybe the premiums reduced as well, depending upon the flexibility of the policy.
One of the benefits of life insurance is you get the equivalent of the tax-free step-up in basis when the insured dies, even if it's not includable in anybody's estate. That's because Section 101A1 says proceeds paid upon the death of the insured are not includable in gross income. And that may be a reason to keep the policy in effect, so you get this automatic equivalent of a tax-free step-up in basis.
That's a very good point.
I'd be very worried that if I counsel a client to cancel an insurance policy or pull it out of their ILIT, that they're going to die the next week or the estate tax rules will change. Apropos to our comments, how it's so uncertain, and your client, Alan, that was very astute, and said, let's put more money in the SLAP because the rules could all change again. You really want to be very careful to think through those what ifs of what could happen 5, 10, or 15 years down the road, depending on the age of the client, before you unravel what otherwise is a good plan. I think it makes sense to reevaluate the policy. Maybe they want a different kind of policy. Maybe they want a policy that focuses more on accumulation of value, cash value, than it does on death benefit. But you got to make sure the client really understands the ramifications, because unlike the control slice of an entity that in 4 years, if we have to, or 8 years, put it back into a trust, if you've canceled the policy, you're out of luck if you want to get it back. I think some of the comments Alan made are very interesting. And I haven't seen anyone talk about it, and I hadn't thought of some of them yet. But in terms of reevaluating existing old trusts, reevaluating title to assets. So if you don't have an estate tax and you can get tenants by the entirety to protect an asset, you can do that because that's no big deal to reverse if the laws change. I think we just have to be careful what we change in case we may want it later. But there's a number of things, like Alan pointed out, that make sense. And why not build powers of appointments into trusts? I mean, there may not be any downside to adding that flexibility. One of the other things, and if either of you want to comment, please do. What about broadening the authority of not only powers of appointment, broadening the authority of a trust protector to deal with changes down the road? Thoughts?
Well, Marty, many, many years ago, I wrote an article called The Master Living Trust, where I suggested that you allow some independent person to change the disposition of your assets for assets in their irrevocable trust. It's very tough to make changes to someone's will, but if I create a trust, whether it's revocable or irrevocable, and I provide, Marty, for example, you or Alan to make changes to take into account future changes in the law, I think that's a tremendously powerful weapon that you can grant someone whom you really trust to do the right thing. So if we have wholesale changes where you want things in the estate or kept out of the estate, or they have to be in a different form, you have someone, even though the trust may be irrevocable, or you have a revocable trust, but the client is incompetent to make those kind of changes.
I'll give you an example of that, Jonathan, that we had spoken about in a webinar probably in 2020 when we thought there would be deemed realization. One of the things that it looked like they might enact is, let's say on the death of the settlor spouse to a SLAT, and the assets would pass from a lifetime trust under the SLAT to a family trust under the SLAT. And then on the death of the surviving spouse, they go from the family trust to descendants trust for each kid. Each change in subtrust we feared could trigger a deemed realization. So one of the things that we had suggested about 5 years ago was having somebody have a power to keep the assets in the upper tier trust to avoid that deemed realization event. And I think what you're saying now is a much broader perspective on just that, because we don't know what's coming.
That is true.
And I think that's part of the general concepts that we're talking about. Estate planning remains critical. It may be for people under 40, 50 million less about the estate tax than it is about income tax, asset protection planning, planning for what might happen in the future in terms of policy changes in Washington, and so on. Alan, any other thoughts on trust protector powers to provide more flexibility?
No, I mean, we put extensive trust protector powers into all of our trusts if the client will allow it. And anytime we amend or decant or reform a trust, we put in the trust protector powers. It's a good thing.
Many people only use a power to remove and replace trustees, change status, and governing law. Can you just give a couple of examples of some of the broader powers you may put in?
Well, we give the power with the consent of the spouse beneficiary, if it's a SLAT, to change the dispositive provisions of the trust, to decant the trust, to change almost anything about the trust. There's no reason not to, because you don't know what's around the pike. The family may become estranged from one child, the other child may win the lottery and want nothing to do with the inheritance. They may move to New Zealand and need the trust to be modified according to New Zealand law. So if you're picking a trust protector who you trust, and family members can have the right to consent to changes, there's really no risk of harm by giving this flexibility. Only being able to replace the trustee doesn't really,
Cut the mustard.
cut the mustard. Exactly.
I was just thinking of the Coney Island hot dog uh, contest on July 4th.
You almost won that, didn't you, Marty?
Joey Chestnut ate 74 hot dogs in 10 minutes. I can't even imagine.
Unbelievable.
Let me just take a minute and belabor, and then you guys should comment. An application of a non-grantor trust for a moderate wealth client. A lot of the planning we've talked about, some people may say that really only applies to wealthier clients, and I don't think that's the case. A lot of what we talked about can be done very cost effectively for clients, well below the $15 million threshold, and should be because of all the benefits that we discussed. But let me give a simple application. Clients come to you, they give, 5 or 10 grand to charity a year, and they're not going to qualify for itemized deductions. You can set up a local home state in their state. You don't have to go to Alaska, Nevada, or South Dakota, or Delaware, etc. Set up a simple home state trust with a family trustee. Set it up as a non-grantor SLAT, so a slant or salty slat, whatever you want to call it. And that non-grantor spousal lifetime access trust will have to have an adverse party, like a kid who's a beneficiary, approve distributions to the spouse. You calculate if they're going to give 10 grand a year to charity based on how on their earnings on their portfolio, how much of their portfolio, which assets in their portfolio should go into the trust. And now each year, that trust will generate enough income to make a donation to charity. They still get their full high standard deduction. And this is basically offsetting the passive income that they would have otherwise had to report on their tax return. It's a very simple way to get a current income tax benefit without a lot of upfront cost or a lot of complexity. And if you build in the trust protector powers and the limited powers of appointment and the spouse as a beneficiary, there's lots of ways to get access back. So the kind of planning we do shouldn't only be thought about for people really worried about asset protection or estate tax. It'll be a very nice, simple income tax play. Jonathan?
Well, let me also mention there are qualified charitable contributions. So if you are over the age of 70 and a half and you have an IRA, you can go ahead and make a contribution to charity, and that will count as your distribution of the qualified minimum distribution from your qualified plans or IRAs. And it's very, very simple. You don't have to include anything in your income. And for people who live in a state, as Marty and I do, where there are complicated rules where, you lose part of your charitable contribution, you don't have to worry about that. It comes right from the IRA to your charity. And you can go ahead and do it. It's very, very simple. And I've done it a number of times because unlike you two, I don't have millions of dollars to give to charity, but my wife and I historically have given money to charity. And this way we can do it. And we don't have real complications, and we get the benefit of getting the deduction for it, even though we can't really go ahead and itemize deductions.
Excellent point.
Let me just squeeze in and forgive me, but when we talked earlier about CRTs and QOZs, and we gave a shout out to Bob Keebler, Kevin Matz was also in on some of those emails, and we should give a shout out to him as well. Anything else, Alan or Jonathan, that you think we should talk about the big beautiful bill? Obviously, we're not going through the hundreds of provisions that it has, but we tried to focus on the estate planning.
I know Marty gets choked up when we talk about this. Well, Marty, another thing that comes to mind as we sit here and I think of client matters is we have a lot of buy-sell agreements among families where the purchase price is really on the lower side of the spectrum in order to avoid estate tax. Well, now we might be able to go ahead and release those and get them to true fair market value in the event of the death. We may not need same type of buy-sell agreements as we had before. The other thing I'm going to say is I'm really looking forward to sitting down with these clients and going over their financial information and their assets and their family members one by one, piece by piece for a couple of hours to say, hey, how come this investment property isn't in an LLC? Hey, do you have a buy-sell agreement on this thing over here? Is your boat insured? The detail of
Do you
going,
own the cars your kids are driving?
why are you owning the cars your kids are driving? We're going to have that opportunity to go through and clean up these estate plans and these families, and they're going to just appreciate the ability to talk to us about something besides estate tax planning. It's going to be good for everybody.
Absolutely correct.
I think what Alan pointed out is really critical. And this is something all the allied professions have a role in, because too many clients get so focused on estate tax that if there's no estate tax fear, they don't understand that estate tax planning, I said it completely wrong. Estate planning, remove the tax word, is still vital for their financial well-being. And, financial advisors are seeking an increasing role in the estate planning process. Educate the clients that they need to meet with their planning team. The wealth advisor, you, if you're saying it, the CPA, and especially the estate planning attorney, because as Alan just gave you a great checklist, there's always things that clients have missed that could really be huge. And now's a good time to do it. And maybe because of the massive changes in the big, beautiful bill, we all have an opening to have these conversations with clients about what they're doing and what should be revisited. You guys have any other comments, or maybe we can wrap up?
I think we're good to wrap it up.
So I want to thank Alan Gassman and Jonathan Blotmacher, alias Mark P., for joining me on this webinar. I hope it gave you some practical insights on what estate planning can and should be after the big, beautiful bill. I'm sure we and many others will continue to do programs evaluating the myriad of tax changes in the bill, and we'll continue to try to give you guidance. So thank you for joining us.
Thank you.